Okay. Assalamu alaikum, everyone. My name is Murtaza Ghazi, and I'll be conducting today's webinar on financial analysis. And before we start, I'd like to give you a brief outline of today's training. So the contents of this training will include a recap of financial ratios, a financial analysis, a drill down approach, holistic financial analysis, a brief summary of the whole training, and a Q&A session at the end. But however, we will be stopping in between if there are some questions. So before we begin, I'd like to first introduce myself. I'm an ACC member, and I've done MBA from IBA. I'm also a certified competent communicator by Toastmasters International. I'm a partner in a financial and tax advisory firm by the name of IFCMG. I have over a decade of practical experience in financial services. Apart from that, I've also worked with KPMG in audit and deal advisory functions in Pakistan and in the Middle East. So just to get things rolling and break the ice a little bit, so can we have a little interaction with some of the participants introduce themselves? Is that possible for us?
I don't think that will be possible, Murtaza.
Okay, there's too many attendees.
Yeah, too many.
Okay. No problem.
Okay.
No problem. So just to move things along, so we've taken a set of financials, or in Pakistan, it's the Indus Motor Company that it goes by the brand that sells and manufactures Toyota motor vehicles in Pakistan. So we'll be reviewing the financials of the company published in the last annual report, and by taking that live case study, we'll be attempting to gain a better understanding of financial ratios, understand the impact of non-finance information, review financials from an investor perspective, and learn a drill down approach to reviewing financials. So before we begin on the financial ratios recap, I'd like to briefly introduce the case company, that is Indus Motor Company. The Indus Motor Company was incorporated in 1989. It comes under the brand name of House of Habib, which is a very large and diverse group in Pakistan. The company manufactures and markets Toyota brand vehicles in Pakistan. And it also, for a brief period of time, it also manufactured and sold Daihatsu products as well. The main offerings currently of the company include the Toyota Corolla, which is its flagship product in Pakistan, Hilux, that is a pickup and a sports utility vehicle category named Fortuner. Apart from that, they also import different vehicles and market them as well. In addition to this, the company also markets and sells spare parts, lubes, and other accessories through its network of independent 3S dealerships. And in addition to that, it also provides after-sales services, from which it also generates revenue, like when clients come in to get their cars dented, painted, and mechanically repaired, and so on and so forth. So we'll just take a brief financial snapshot of the company. It covers the units sold, which is 64,000 units in 2018, and in 2017 the units sold were 60,596. So that's a 6% increase. So we'll be delving further into these numbers further on, but just to give you a brief overview of the financial results. The net revenues of the company have increased by 25%, but if you look at the units sold, they've only increased by 6%. So that is something we need to look into. And furthermore, you can see that profit after tax and profit before tax have increased by slightly lesser percentage, by 20% and 21% respectively, as compared to the growth in revenue. And finally, the return on equity is as an increase by 3%. So this is a brief snapshot of the financials. We have total assets of 81 billion rupees, and out of that we have liabilities of around, how much is that? 45 million of liabilities, and the rest is all equity. Profit of the company. This is a slightly detailed profit and loss account. So we have net sales, cost of sales, distribution expenses, administrative expenses, other operating expenses, workers, profit participation fund, other income, finance costs, profit before tax. So it's very critical here to know that both of these sets of accounts, financial statements, they do not operate in isolation. If there's an impact on the asset side, it will inevitably translate to an impact on the profit of the company, and vice versa. If there's changes in the financial statement, profit and loss account, and impact on expenses or impact on sales, it would inevitably affect the balance sheet. So it is very imperative that when you're moving on, when you're analyzing a financial statements of a company, you keep all things in perspective. So here we have a brief recap of the ratios. Profitability ratio. We've taken just two main profitability ratios, GP margin, and which is calculated by gross profit upon sales. Further, we have net profit margin, which is calculated as net profit upon sales. And then we have liquidity ratios. The first ratio that I learned that it was the current ratio, that is current assets versus the current liabilities. How much money we have to pay off each rupee of liability. Then we have quick ratio and acid test ratios. And finally, we have investor ratios. We have return on total assets, earning per share, and net income divided by average number of shares. So as you can see in the financial results, that we have a very good liquidity ratio and current ratio, and the profit margin is pretty healthy as well. So the profit margin, it comes around to 17.3% is the gross profit margin, and in the previous, it's down slightly from the previous year when it was 17.7%. Operating profit margin is 15.3%, which is again down slightly from the previous year of 15.4%. Liquidity ratios are more or less similar, with slight decreases observed here as well. So moving on, we have the investor ratios. We have earning per share and PE ratio, and return on total assets. Return on total assets is pretty significant, 29% and 31% for current year and prior year respectively. Then we have gearing ratio, which is again very unique to every company depending upon the industry and the business model. The gearing ratios are very we've calculated as debt to equity, debt as compared to equity. Debt is it is 1.2:1, or in percentage terms, it is very favorable as well. And we have finally in the gearing ratios, we have next up we have the interest cover ratio, which is interest upon profit before interest and tax. This denotes how much interest, how much profit the company has to pay up, pay its financial interest obligations. And finally, a very critical part of the ratio financial analysis is benchmarking, because reviewing information in isolation is not a good idea, because we don't have anything to compare it with or compare it against. So benchmarking, we have many criterias. I've just listed a few here that we'll be discussing in more detail as we move on. The first one is benchmarking. The simplest form is comparing it with the prior period results. The second is against similar sized competitor in the same industry, or if we want to look up to and compare ourselves with industry or market leaders, we can compare it against the local industry or market leaders as well. So now we'll be moving on to a more detailed approach, which I call the drill down approach. We drill down into the numbers and we consider various factors that impact the performance of the company. So first up, the top line of the financial statements in the profit and loss account is the sales. The sales numbers can be impacted by various of reasons, and the two factors that make up the relationship are the price and versus the volume. So as we noted in our initial brief snapshot that we saw, that there's only a 6% increase in the number of units sold by Indus Motor Company. However, revenue jumped up by 25%. So if you can see, we've done an analysis here. We've taken an extract of the sales, and we have here gross sales, which is the net of sales tax and commission and discount. So we have two sources of revenue. One is from production and the other is from trading. The production revenue is from the manufacturing of vehicles, and the trading part is from the selling of spare parts and lubes and oils and other stuff. So there are a number of things that we need to consider when analyzing sales. First up is the customer base. Is it narrow or is it wide? So if you look at Indus Motor Company, the customer base of Indus Motor Company is very wide, because the market of customers of motor vehicles is very fragmented. There's no major corporate buyer that can really dictate terms to the Indus Motor Company. It's usually, even if there are companies, it's usually either customers who are buying one car, or a company that's buying 10, 15, 20, 30 cars. So the customer base is very wide, and that is a very good thing in favor of the company. That means that the company does not allow its customer to dictate terms. And the next factor that we need to consider when analyzing sales is the product base. How much of this revenue is derived from a sale of a single product? What product variety do we have? So for Indus Motor Company, we can have a narrow product base. We have a very narrow product base. Their major source of revenue is, as most of us in Pakistan know, is the sale of their evergreen Toyota Corolla. That is their flagship product. They've tried unsuccessfully to diversify their product base, but inevitably they're still dependent upon Toyota Corolla as a major driving force of revenue. While they have around 6 to 7 variants of Toyota Corolla, they also have SUVs and other vehicles in their portfolio. But in the sedan category, they have mostly they have 2-3 other cars. They have hybrid cars as well, Prius, and they also have some crossover vehicles. However, their prime source of revenue is still Toyota Corolla. Another impact that we must consider when analyzing the performance of sales is the seasonal variations. Now, it's not necessary that the company's seasonal fluctuations are all documented within one financial period. So, for example, we have 2 or 3 seasonal variations in Pakistan, The first is Eid, that a lot of people want to buy a new car on Eid. So that is one seasonal impact that sees a hike in sales. The other seasonal impact is when the new year starts, that everyone wants a new model, new car in the new year. So the bookings of the company really jump up at the tail end of the year. So which is usually why they roll out newer models in the last quarter of the year to boost up sales in the third and fourth quarter. However, again, there's major impact of the seasonal variation at the year end. And another, because we are primarily an agri-based economy, another driving force between on the sales of Indus Motor Company is the agriculture when harvesting season takes place, and that is when the smaller farmers buy motorbikes and the larger farmers buy either Prado or Corollas. And thirdly, we have geographical concentration. How much is the sales concentrated in one area or the other? Now that is in Toyota Indus Motor Company. I don't have the data exactly, but it is my estimation that it is very fragmented with a large concentration in the urban areas of Pakistan, Lahore, and Islamabad. And finally, the last factor that we need to consider is the legislative impacts. A lot of you would be aware that recently the government of Pakistan passed an amendment to the tax laws whereby no non-filer could buy a vehicle over 800 cc. That caused a lot of uproar and outrage among the car manufacturers of Pakistan, because that meant that a huge chunk of their market was lost. Bookings were cancelled, car deliveries were withheld, and after a lot of uproar and outrage, this legislation was reversed. So you can see legislations also have impact on sales. So we saw the negative impact of this recently, like I just described, but it can also have a positive impact. For example, if the company uh, is bound by law to only sell and market hybrid vehicles to encourage clean environment, so the revenue will automatically jump. It will have to cancel its sales of normal vehicles and promote and push its hybrid vehicles to the market. Moving on, we have the cost of sales. The cost of sales of Indus Motor Companies is primarily divided into three main areas. The first is raw materials, second is production or the manufacturing process, and the third is finished goods trading. So there are a lot of things that you need to consider while analyzing the cost of sales of a company. Now, in the case of Indus Motor Company, which manufactures primarily imported raw material or imported parts, which it uses in its manufacturing process. So raw material is critical. As you can see, purchases are worth 101 billion in the year 2018. So while this is not the singular factor that needs to be considered, we also need to consider other initiatives, because where inventory is involved, there are other components that need to be considered, like we have logistical concerns. If the where the manufacturer of the raw material is, how will the good be transported, and how will it be stored? What are its logistical and warehousing requirements? What is the lead time? How long will it take? All of these things dictate the order size as well as the ordering requirements of the company. So For example, if we just see two competitors, Toyota and Honda, and Indus Motor Company is located in Port Qasim. The plant is located at Port Qasim in Karachi, whereas Honda's plant is located in Lahore. Now, from a cost of sales perspective, both companies are similar in the nature that they import their components from abroad, but logistically, Indus Motor Company is better off because it's located right at the ports. So transportation costs from the port to its warehouse will be very minimal as compared to transportation costs incurred by Honda. So Honda's cost would be much higher because its plant is located somewhere near the central region of Pakistan. So additional logistical time required, that translates into additional lead time as well. Additional lead time means you need to increase your order size. Increase order size means you need to hold more inventory, which means you need to have additional holding capacity as well. So, moving on, we have further, we need to consider also there is a concept that is commonly taught to us, which is known as economic order quantity, whereby the holding costs and the ordering costs are minimized, cumulatively using that process. So that is something that the companies need to consider, that what is my EOQ, where at which point will my ordering costs and holding costs be minimized. We need to have also the other considerations, that where are my sources of raw materials? Is it imported from abroad or is it local? In the case of Honda and Toyota, like we just discussed, the majority of the raw materials are imported, so they need to build in additional lead time, which leads to higher inventory levels that they need to hold in order to keep the production process going. However, if the source of raw material is local, as is the case in a number of their spare parts, like for example, a very famous example for Toyota and Honda is Lloyd's Limited, which manufactures silencers and mufflers for both of these companies. So that is locally manufactured. So Toyota then has a lower lead time, and they need to hold lesser stock of locally sourced materials as compared to imported materials. And also, there are other considerations when you source material from abroad. The key point being the foreign exchange rate. What is the forex rate? How much will our currency be depreciated or appreciate in the duration of the lead time? For example, a standard LC, or letter of credit, where you source material from abroad, takes around 3 to 6 months. And in the past 8 months, Pakistan's currency has appreciated by 35%. So just imagine we're standing here at 100 rupees per dollar, for example, and I'm forecasting that I'm ordering a raw material of 100 rupees, and that raw material is due to be delivered in 6 months' time. So I have provisioned that I'll be spending 100 rupees on my raw material, and I've marked up my cost and quoted my selling price accordingly. So just assuming that my margin is just 20 rupees, 20%. So I'll be quoting a price of 120 rupees to my client, and then I'll be processing the order accordingly. But when the time comes to make the payment for the material, currency has depreciated by 35%. So instead of 100 rupees, I'll be paying 135 rupees for my materials, whereas I'm already bound by my client to receive 120 rupees from them. I cannot pass on the costs onto them usually. But as we have seen recently with the Indus Motor companies, they managed to pass on the cost of regulatory nature, which was, as you may be aware, they had increased the federal excise duty on the sale of vehicles, and that is the cost that was passed on by Indus Motor Company to its vendors, clients. Other factors that need to be considered are the quality of machinery that is available to us. So it, like I said before, we have to continuously link our balance sheet with the profit and loss, because no, the impact of in one area will be felt in the other area. So obsolete or inefficient machinery would result in high material consumption and high repair maintenance costs, but lower capex expenditure because we'll be using that same old machinery again. However, contrastingly, if we say that okay, we need to get a new, more efficient plant, so that initial cost of plant will be very high, but the plant will pay dividends when you have efficient consumption of raw material. We have lower repairs and maintenance costs, but the impact will also be again increased in depreciation cost due to the high cost of the plant. So these are things that we need to consider. Further, we need to consider that the impact of related overheads, how efficiently we're managing our human resource, and in addition to our capital resources. That includes efficiency of labor, how many, how much time we budgeted, how smooth the production process flows, and further we need to also identify our levels of inventory. Are they high or are they low? Because higher inventory levels inevitably mean higher profits, because it is directly adjusted from cost of sales. So for a trading business consideration, trading business, we need to consider other things as well. So for trading business, we need to consider that the material should be easily stored. The storing requirements should be very minimal, and the storage cost and ordering cost should be very low, so the margins can be high. So we can look at how much space the material takes up against how much profit it generates. A very good example of that is in medicine, in the medical industry, pharmaceutical industry. There's a bandage that is used, a crepe bandage, that costs a few hundred rupees, but it takes up a lot of space. So in order to make say a similar impact, a similar cost, we need to translate the, we need a lot of volume to make a similar profit that say one drug for cancer, that a small vial of injection for cancer generates. So again, so that is something that we need to consider, the space required as opposed to the costs that it incurs. Sources of material, again, for a trading business, whether it's local or imported, that needs to be considered. For imported, for trading businesses, a very good example is for imported cars that are currently, it was reported last month that there's been a drop of around 50-70% approximately in the imports of reconditioned or used cars in Pakistan. So correspondingly, this should be impacting the local economy a little better. But again, so these are the things that we need to consider when analyzing the cost of sales. So coming back to Indus Motor Company, so we can conclude that majority of their imports, majority of their raw material is sourced from abroad. So the foreign exchange policy or the foreign exchange rates dictate a lot of carry a lot of weight in their decision making, and as a company we need to then take uh, measures to counter that negative impact. Okay, now moving on to admin expenses, a very common area that I just skipped for from the cost of sales section because it is common in both administrative and cost of sales. So depreciation and salaries and wages, utilities, these three expenses are those which you can directly identify, but some you have to take an assumption to allocate. So the assumption for allocation would also be very critical and very crucial, that how they are allocated and how they are, what is the basis of their allocation. For example, if the company uses activity-based costs for allocating utility expenses, just say for example, so if, for example, you use that, so that will mean that the majority of the company will then be identifying the cost drivers that impact the utilities expense. So taking those utility expenses into account against the activity that drives up the costs. So the utilities, will just isolate it for a moment to electricity. So electricity is most consumed when you use equipment. So where do you use equipment? You use equipment in your plant. When you use the manufacturing machinery, you use electronic appliances to handle equipment, handle material. Then again, you have some appliances for the staff, which consume power as well, like fans and infrastructure like lights and AC, etc. So if we assume that we want to allocate the costs as per those requirements and activity based, then the costs allocated to the manufacturing process will be much higher. Correspondingly, if we say we want to allocate the costs as per space taken up, so the allocation would be less skewed in the favor of manufacturing as compared to activity based. Other expenses that are commonly allocated include rent expenses, other utility expenses, salaries and wages. And the key element that we need to consider here, and cost of sales again, is the fixed and variable component of our expenses. So this comes in most commonly in utilities, rent, and salaries and wages. So we have some direct labor costs, which are usually direct. We have some fixed and some variable component. So the worker may be getting, say, a fixed salary, but in case of additional demand for production, he may be required to work overtime, which is variable. Administrative staff, again, may be required to work on a fixed salary, but will have probably a variable component based on their performance, which are included in the accounts as bonuses and performance awards. Other expenses that we need to view, again, we need to consider and drill down in each of the line items, that what is driving these costs and how are they ending up where they are. Have they been allocated, or are they directly attributable, or have they been apportioned, and so on and so forth. So the next item is other income. So other income, in case of Toyota, we have split the other income into two areas. We have income from financial assets and income from other than financial assets. So those who are not familiar with the Indus Motor Company business model, I'm just going to refresh your memories a little bit. So what Indus Motor Companies does, they take up take a majority of the payment at the time of booking of the order, and before delivering the product to the customer, they then take the balance. They then take 100% of the payment from the customer before delivering the vehicle after 15 days, month or 2 months from the final payment receipt. So what they do is, because the business model is unique in the sense they don't have much long credit period for their majority of their sales, and they get the money in advance. So they utilize those excess funds by investing in various areas. So again, I'm going to circle back to the balance sheet just to recap the things. So we have short-term investments worth 55 billion rupees in 2018 and 41.5 billion in 2017 short-term investments. So we're going to circle back to the other income. So you can see we're generating 3 billion income from financial assets against 51 billion, and approximately 2.9 billion from financial assets in the previous year. And then we have income other than financial assets. So the things to consider here are, number one, disclosure requirements, because as per the company's ordinance requirements, the entity needs to review its disclosures, that when a line item exceeds a certain percentage of the other income, it has to be disclosed separately as a line item. And there are again tax implications, whether this other income is subject to the same tax as the company's profit or not. From an analysis perspective, we need to review the nature of the items classified, which is why, while the note is very detailed, I've really summarized it here to just get the gist of the matter. So we have income from financial assets. So that is income from investments, which I've just shown, and income from other than financial assets, which are other income, which includes some income from disposal of fixed assets and other items. So we need to review that how much of this income is of a recurring nature, like the income from financial assets is of a recurring nature, and how much of this is a one-off occurrence. A one-off occurrence can give an unnecessary spike to your numbers and give a misleading picture. For example, I once was reviewing a company's numbers. I can't disclose its name. So the company had booked its assets. They were written down at zero, and then the company decided that all right, we're going to sell off a huge chunk of our operations, and we're going to dispose of these written down assets. So those assets were included plant and a few vehicles and inventory handling equipment. So all of those assets have been in use for a number of years and their book value was nil. When the company disposed it off, however, the gain on disposal was in millions of rupees, and that doubled its bottom line. So when the owners were analyzing their numbers, and we were discussing for a meeting, and they were saying that, oh, look at this, where numbers have doubled from last year. So when we analyzed the numbers in detail, so we then concluded that the profit had actually fallen by 5% from the previous year, and the spike was only because of the numbers coming in from the disposal of fixed assets. So that is again something when we need to consider carefully, and we need to drill down on the details that we require of whenever we are analyzing numbers. So just not take the bottom lines on the face value. We need to drill down even on the ratios, on the impact, and analyze the individual ratios the individual components of the ratios. For example, in gross profit margin or net profit margin, the sales and the profits. Okay, what is the profit impacted by? What is the sales impacted by? As we have discussed. Now, coming back to the profit and loss review, the thing that is most critical for crucial for the investors is how much money does the company actually make? Because the profit and loss account includes a number of notional values like depreciation, tax, or amortization that have no monetary or cash flow impact. So it is very essential for investors to know how much money does the company actually make. So I've just simplified this here on our presentation, but it is a very complex uh, method that we need to consider, where interest tax will then be adjusted with the cash outflow. But for purposes of this presentation, I've really simplified it. We just added back the notional values of EBITDA, that is earning before interest, tax, depreciation, and amortization. So we've added back interest, we've added back tax, depreciation, and amortization. So, and that number comes up to, from, we're sitting at 16 billion approximately, and we've come up to 25.5 billion. So that is an increase of 62%. So 15 billion on one side, 15.6 billion. On the other side, we're standing at 25.5 billion. So there's an increase of almost 10 billion rupees in earnings in 2018. And the percentage was also similar in 2017 as well. So this uh, can give us a better idea, all right, that this is what the company is actually making, and this is a crucial tool used by analysts for business valuations. So moving on, we have a very good tool for analysis that is called the waterfall charts. So we can use this from in a number of situations. The ones I've used it is to illustrate how we arrive from the gross sales to the net income. It can be used for EBITDA, it can be used to compare 2 years numbers as well. So we can start off with the previous year's number and then we can move on to this year's numbers. So this can help analyze that, all right, which is the critical or the most significant component that impacted my financial performance. So you can see here that we have gross sales, net sales, returns, other income, cost of goods sold, expenses, salaries and wages, net income before uh, tax, then net income. And you can see through this chart that, all right, we have a significant decline in the major chunk of sales that goes out is due to cost of goods sold and salaries and wages. So these are the two numbers that we need to analyze that can be used to improve the numbers of the company further, and we can drill down on the key impact in the financial statements. So moving on, we move on to review of the balance sheet. And in balance sheet, first line item is obviously property, plant and equipment, or the fixed under the category of the fixed assets. So factors that we need to consider in fixed assets are very many. In property, plant and equipment, we need to consider the composition, that is the composition between land, plant, and machinery. So that will tell us that how smartly the money is invested, and that again, this composition will vary from business to business. For example, in the case of a manufacturing company, a major chunk, I have the fixed asset schedule here of the Indus Motor Company. So you can see that out of tangible fixed assets of around 7 billion, we have 1.1 billion on factory building on leasehold land, 4 billion on plant and machinery, another approximately 1 billion on jigs, molds, and other related equipments. And we can further club in tools and equipment and other building on leasehold land. So we're pretty much staring at around 90% of the total numbers of the total tangible assets. The numbers for a trading company might be contrast to this, because trading companies don't have requirement for manufacturing equipment that much. A more key component of their cost will be taken up by warehouse space, warehouse fixtures, inventory handling equipment, and they won't have any chunk in plant or machinery or manufacturing building. And another change that will be from trading to a manufacturing concern is that manufacturing companies are more likely to own their land because they require a lot of it, and renting it out would be a huge drain on their resources. Contrastingly, trading businesses like retailers or restaurants or any other finished goods trader would probably prefer to have a premises on rent, because their space requirement is much lesser, and the turnover period is much higher. So this is a difference that you should consider when analyzing property, plant, equipment. Uh, Secondly, we need to consider revaluation. So revaluation here means where how and when the fixed asset is revalued. As I stated previously in my previous example about the client who disposed of its fixed assets at nil book value. So if the client had revalued its fixed assets, it would have the gain would have probably been lesser as compared to the gain it had realized when it had written down its value. So we need to consider that how much of that money is actually invested. So a very popular ploy used by companies to boost up their assets bottom line is revaluation, and this tool is primarily used in leasehold land or land. Land, because land appreciates the most out of all the assets which depreciate usually, and again this composition will again be used to analyze how and why the assets are then being depreciated and their costs be subsequently being allocated. So from a perspective of companies, the allocation of costs is again all based on the composition of plant and equipment. So we have, if again going back to their fixed asset schedule, so we have plant and machinery, and we have office equipment, and we have computer and related accessories. So if we just took a brief composition, and sorry, we can also look at the depreciation rates at the bottom of your screen, which is 2.3% to 3.85%, 10%, 5%, and 20% and 33% for computer and related accessories. Okay, so if the composition was changed and it was coming that leasehold land dictates most of the cost, and plant and machinery takes up the least of the cost, so depreciation charge would be very less. However, in the current scenario, the depreciation expense is dominated by the plant and machinery and other tools and related equipment. Next thing we need to consider is capital work in progress. Now, capital work in progress is assets that are under construction and have not yet been deemed fit for use by the management of the company. This again is an area that companies can use to their advantage to window dress their financials or inflate their numbers. Uh, for example, we need to review capital work in progress. We need to review that first. We need to review the capitalization policy, whether the assets that are in capital work in progress are indeed fit for fit for capitalization as per the company policy. The second thing we need to consider is aging. How long has that fixed asset been a CWIP or a capital work in progress? So I worked on a client once that used to this thing to their advantage. So they were engaged in a renovation project of their company premises, and they had two floors, a ground floor and a first floor. So what they did was they renovated the first floor, and then the staff vacated the ground floor premises, so renovation could begin there, and they shifted to the first floor. Now, the renovation for the first floor was complete, and the furniture was there, the fittings were there, IT equipment was refitted, and the staff was working basically. And but because of the fact that the ground floor was not working, was under construction, the management had treated the complete thing as one project and had not capitalized uh, the cost of the first floor renovations. They were of the view that we have commissioned this as one project, despite the fact that the company was using the first floor assets, but again, it was placed under capital work in progress, and as a result, the company was not taking into account the depreciation expense of the renovated floor. The second is capitalization policy. That what is the criteria of capitalization for the company? Some companies have a monetary value fixed. Some companies have fixed that the company should have proper analysis of what the purchase is and how much it is under use. So those are the things that we need to consider when reviewing the fixed assets. And the last thing that we need to consider is the depreciation policy. Is the company using a straight line method or a reducing balance method? And that directly impacts the company's numbers in accordance with its policy, because reducing balance method, as you may be aware, it takes a huge chunk initially of the cost, and then subsequent years it reduces lower and lower till the number becomes negligible. The straight line method, however, takes it in a smooth manner, and every year the same number hits the company's financials. And finally, we need to consider that for the purposes of revaluation, we just missed one point on revaluation, that revaluation is very subjective, and a subjective area, it's open to interpretation. So that is something again we need to look at, and we may need to isolate that. For example, that in the fixed assets of say around just in this motor company, the fixed assets are of 7 billion, and we can assume, for example, that the leasehold land worth 78 million rupees as of now could be worth 1 billion rupees. as per today's commercial terms. It's an assumption. So that would drive up the cost of fixed assets from 7 billion to 7.2 billion to 8.2 billion. But then we will need to say, all right, let's check out the composition of the fixed assets, and then we isolate, all right, this is the bottom line, and this has been the bottom line shot up because of revaluation. So again, that is, we need to then check uh, who revalued and why was the land asset revalued, and what will be the impact of it in the bottom line. Okay, moving on, we have intangible assets. Intangible assets include goodwill, licensing rights, amortization of software. So we need to consider here that as uh, whether the expense that needs to be cost that needs to be expensed out has been capitalized or not. For example, a lot of companies use this to defer expense because that's what depreciation is. That you take a cost of the asset and you defer it over the period, the life of the asset. So they have, for example, they pay a consultant, or they pay consultants for installation, or they pay consultants for subsequent checkups or subsequent work on the assets installed and operational, and they capitalize them. So this would be then be that mean this would mean that the cost of the asset is then deferred over the life of the asset, and then it's up to the analyst to really judge and drill down on the impact and the reasoning behind recording of those numbers. Then we have impairment review of goodwill. That is another critical area, that whether the company's goodwill should be impaired or not. So overall, for fixed assets, it's also crucial that we revisit the useful lives of the assets that are recorded, be it fixed asset or intangible, and how viable is it to place them or hold them at their current cost? Do the as the useful life reduced, or have we undertaken some work that increases their useful life, and the impact of that on the expense, depreciation expense, will also need to be considered. So, for example, we have say a licensing right to distribute a product under a brand name, and the licensing right runs for 10 years. So towards the end of the life, we then approach the licensing company and ask for an extension. So that extension would come at a cost, but then our extension would, instead of then, for example, we're starting at year 9, and we approach the company for a 3-year extension at the end of year 10. So at year 9, we incur a certain cost that would be added to the licensing cost, but the useful life of the license would then be revised from 1 year to 4 years. Okay, next up we have the current assets. Just a snapshot of the Indus Motor Company. We have stores and spares, stock and trade, trade debts, loans and advances, prepayments, accrued returns, other receivables, short-term investments, and cash and bank balances. As you can see from the composition, you may recall that we had discussed that Indus Motor Company sources its raw material, majority of its chunk of its raw material from abroad. So you can see that reflected in the inventory here, which is 11.1 billion. And we talked about their business model of taking advances from customers, and you can see that 55 billion is in short-term investments, which was reflected in the other income. Now the stock and trade coming in at the cost of sales in trading gross profit, and the short-term investments that come in at they impact the other income. So out of 74 billion, we have 55 and 11, 66 billion is tied up in just two assets. So inventory, things that we need to consider factors in inventory. So this is a more detailed breakup of the 11 billion. So you can see we have raw material. We need to consider inventory levels as discussed previously, the economic order quantity, what is the ideal level of stock that a company should hold. So we have, as you can see, at each point there is a provision for slow moving stock, and at each point. So this is because it is very critical that our inventory is not overvalued, and a slow moving stock and obsolete inventory is identified and accounted for. So this is coming in raw material, this is coming in finished goods, this is coming in trading stock, and this is coming in spare parts as well as but on in transit. And again, we said that raw material is sourced from abroad, so we have a lot of raw material in transit, around 5 billion, and trading stock just 244 million. That is very minimal compared to the trading stock. So we need to review that how much of the stock is actually tradable and not obsolete. Is it current, or we need to currently review the impact of stock at the end of the period. So, for example, if say there's a legislation passed that diesel vehicles are not allowed on the road, and company is holding a lot of inventory of finished goods of diesel vehicles, or and is also manufacturing, so the company would then need to write off that stock because it's no longer a viable sale option. It has minimal market value. And we need to also reconsider that if the company has any discontinued products in stock, that is, it is not selling in the market, but it has it on hand. A very common example of this is the old models spare parts that the company holds. Like for example, if the company has been operating since 1959, so we can say, so we can check that. We can check that the trading stock. Yes, we just pause for a minute. Can we go? Okay, so for inventory, we need to consider the aging of the inventory, whether it's obsolete stock or whether it's damaged or out of discontinued stock. Then we need to consider work in process. How long? Again, at each point there has to be an aging, and work in process is usually because Indus Motor Company is a very high in demand and fast moving company in the sense that they have a lot of backlog of orders. So working process would probably not be very old. But in other companies, manufacturing process as well. So if the manufacturing process is very long and the working process needs to be revisited, that is the work in process, does it need to be damaged? Is there some problem in quality? Do we need to include a provision for that? And finally, we have stock in transit. Now, stock in transit, we need to check whether subsequently that material has been received, and if that material is insured, or what is how we have sourced that material. Is it through proper channels, or is it through some shady channels whereby the reliance of the vendor delivering is under threat. Okay, now moving on, we have receivables. Now, receivables, as you can see, the company has very minimal receivables. If we just go back to their turnover, just take a minute. So, the turnover of the company is 140 billion rupees. 140 billion, and against 140 billion, we have only 1.5 billion in trade debts. That is a very good percentage because that means the company receives its most of its cash in advance. So as a percentage of sales, it is very minimal. So now we're going to tie. Now we're coming into fixed assets and current assets, and we're going to tie that into the working capital requirements. And so inventory. So we have a cycle that I'm going to describe ahead, but just to revisit here, the credit period to trade debtors is how much period we have given to our clients from the point of sale to the point of recovery. Then, as a percentage of sales, how much of our sales is driven by credit terms? That is very important to reconsider. That whether our business model is driven primarily through credit sales or through cash sales. Next, we need to consider aging of the trade debts. As you can see that there are a few debts that are overdue from 1 to 6 months and more than 6 months that are disclosed, and again very minimal, but the company has disclosed this information nonetheless, and it has clearly stated that these are these include various customers including government organizations and with no history of default. But if we look at other business models which operate primarily on credit, for example, we can look at financial institutions. Again, the nature of the product of banks is loaning out or giving finance to motor vehicles is purely on credit terms. You can't have like a prepaid loan. So we need to consider that individual industry and how it operates in that industry. What are the industry norms? How is it? How the company dictates its terms to clients, and how clients can dictate its terms to companies. And another thing is that again we can refer back to our circling back to our sales, the concentration of customers, the concentration of products. If there are very few customers, then chances are that they'll be dictating terms to the company. And if they dictate terms, the most common term that they dictate is credit period and lower profit margins. Now, if we come to Indus Motor Company, coming back to the Indus Motor Company, we have a concentration for very fragmented customers as well, and we have government organizations and others. It's almost evenly divided. The number is very small as a percentage of sales, and but this we need to again consider that how many days does it take from our inventory to turn into a sale, and how many days it takes for our receivable to translate into cash. Next up, we have uh, current liabilities. The current liabilities are, include current portion of deferred revenue, unclaimed dividend, unpaid dividend, trade payables, and advances from customers and dealers primarily. So we need to first bifurcate and identify how much of these are interest-bearing liabilities, how much are non-interest bearing, and advances from customers, what commitments we have made to the customer, what will happen if we default on our commitments. And again, we have creditors that, again, how much we can leverage someone else's funds to against our own funds. That again comes plays back into the working capital cycle that we're building up towards. So to sum up the current liabilities, we just need to again drill down and see what drives these numbers up. For example, out of 45 billion liabilities, that is primarily driven by two main heads, that are trade payables and advances from customers and dealers. So out of 45 billion, around 42 billion is concentrated in two heads only. So just to wind up some of this section, that trade payables, again, we need to delve further in and what are the notional expenses in there, like accrued expenses, provisions, and other payables, and how much the company actually has to pay, and how are those numbers calculated, and what are the bases? Are the bases realistic? Like, for example, for provisions, we can use, the company can have provision, say, for example, a provision for warranties, that a company provides warranties, and uh, based on some grounds, the company makes a provision of, say, 2% of revenue or 1% of revenue. But again, we need to investigate the basis. That is the basis of the provision realistic or unrealistic? What is the method behind that? Say, for example, a lot of companies that do provide after-sales services, they calculate their warranties based on past experience. So you have 5, 10 years of data, and then you calculate the provisions based on that. However, if, for example, you've completely transformed your business model, and then again you're focusing on just the uh, just the past practice, then it would be unfair to the company, and very difficult for the company to justify those numbers. Say, for example, we had a manual manufacturing process, packing process, for example, whereby there were some defects in the packing that inevitably led to warranty claims. However, if we've automated that packing process, that should mean that a warranty claim should be lower, and a percentage should be revised to a lower number. Finally, we have long-term liabilities. With that, we need to check again gearing and leverage of debt, and the conditions or covenant requirements of the debt. What collateral have we provided, and what are the covenant requirements? So I'm just going to explain a little bit about the how the financing of a company works. So the company usually has 2 or 3 sources of debt financing. One is the current financing requirements, that includes trade finance, where a company uses the letter of credit facility or import bills, import LC, those kinds of facilities to finance its day-to-day operations. Another finance that a company commonly uses is running finance, which is short-term working capital requirements, which is used interchangeably with the trade finance product. And the third uh, common product that a company uses is a long-term finance that can be obtained in many forms. It can be a long-term loan. It can be a bond, like recently K Electric has issued a bond against its assets. So what analysts need to consider is not only the only single number, that what's coming in the long-term liability, how much of it is interest bearing, how much is of it is it non-interest bearing, and under what conditions we have obtained that facility. What are the covenant requirements? Covenant requirements are mandatory thresholds that a company must meet in financial terms in order to maintain or keep utilizing its financing facilities. Common covenant examples include maintaining inventory levels, for example, or maintaining a certain level of receivables or a minimum cash balance that they must hold, or maybe that can include covenant includes that a single charge registered against a property, a singular charge. That means that, for example, I have a property worth 10 billion rupees, and I'm obtaining a finance of say 1 billion rupees. So I go up to my bank and said, all right, I need a financing facility of 1 billion rupees. So the company then says, all right, the bank says, we can give you the facility, but on the condition that we will be the sole lenders on who are secured against this property. No other lender can be offered this property as collateral. And if that happens, so then again, we can circle back to the influence of lender on operations of the company. So, for example, one of our covenant requirements is registering a charge against a property against for a company. That would mean that our lender dictates whether or not we can sell our property if we want to, because we cannot sell the property without the consent of the lender. We will first have to repay the debt, and then obtain a clearance certificate and no objection certificate from the lender that okay, your charge has been removed from the property, now you're free to dispose it of. Or uh, other covenant requirements like inventory levels. So inventory levels, for example, let's we can revisit back our cost of sales and inventory discussion, where we discussed that inventory levels should be dictated by economic order quantity, whereby the cost of ordering inventory, cost of holding the inventory, and the cost of the inventory itself should be minimal. However, if a covenant bounds us to hold inventory that is twice as high as what we initially had, what our ideal level is, then obviously the influence of the lender on our business comes back. So, and we do not have the freedom to operate as we want. So, we're going to recap a very primary concept. We have sales, we have the sales cycle, and we have the purchases cycle. We have so sales translates into trade receivable that may include sales returns, discount allowed, and then cash received, which concludes the sales cycle. The next part of this working capital cycle is the purchases cycle, where we buy inventory that results in trade payables and then results into cash paid, ultimately concluding the purchases cycle. So what we need to look at here is how to use the finance and how much finance we need to use to finance our operations. If you look at sales cycle, so for example, sales cycle versus the purchases cycle. So in purchases, what we have, we should have a credit period. We have a credit period, we're utilizing someone else's funds to run our operations. Correspondingly, when we make credit sales, we initiate the sales cycle where someone else is using our funds to finance their business. However, will have to pay from our own pocket to cover the duration of that. So ideally, our purchase cycle should be greater than our sales cycle. So we'll be leveraging someone else's funds to use in our business. However, that can have a corresponding impact because we all know that liquidity is the critical area after profitability when analyzing any company. So if I'm profitable and I don't have any money, so it's not a very fruitful operation for me. So and if you look at this, the Indus Motor Company, it can be we can look at their. We've already discussed the business model. So we have stock inventory turnover, we have receivable turnover, payable turnover, and working capital turnover. That is the net of these three numbers. So the stock and trade turnover is 35. It takes 35 days on average to convert our inventory into sales. And 4 is the receivable turnover in days. That means we are taking 4 days to convert our sales into cash. So we are taking 39 days to, we need 39 days of finance to finance our sales cycle. If we look at the payable turnover in days, that is 57 days. That means we have 57 days to utilize someone else's finance for our benefit. As you can see, the Indus Motor Company's model is primarily based on getting advance from clients. The working capital turnover in days is in negative, which indicates that the company has surplus payable days and its sales cycle is shorter than its purchases cycle. However, this is not an ideal position for every company because, again, as lenders, what lenders usually look at is also leverage. At how much of our own, how much of equity is the company putting up against the debt of the lender? So if that exceeds the former, that means that the debt is higher than the equity in the business. So it can negatively impact the business operation in terms of financing cost. Because if you recall that the weighted average cost of capital is cost of equity plus cost of debt. So while debt is usually cheaper than equity, however, when the volume of equity goes down, the cost of debt then goes up. So a company can use this working capital cycle to ideally analyze its business operation cycle, and it can gauge its liquidity position and also identify where improvements can be made, how receivable period can be shortened, how working payable period can be lengthened, how inventory turnover days can be lessened. For example, if we look at stock and trade, we have we can shorten that by reducing our orders. Smaller orders means that inventory turnover will increase. However, smaller order means that the number of orders will increase. As a result, if the volume of orders shrinks, we may be losing out on discounts that we may get. We may be losing out on the credit period that we may get because just assuming that our volume of orders reduces below a certain threshold, the vendor can shorten his credit period. The vendor can shorten his or restrict his discount. The vendor can also then give us inferior quality inventory if he sees we're not working on his terms. Similarly, uh, and again, this will impact our quality. If we're making finished products, we provide after sales service. This can impact our warranty claims. Inferior quality material. This will impact production problems. Normal wastage will be increased because that would mean if you're using inferior quality of material, then in the production process, inferior quality material usually means more holdups in the production line, increase in defects in the production line that will inflate our costs. For if we look at receivable turnovers, so we again, like I discussed before, you need to revisit the business model. that what our business model essentially is. If it's driven by credit sales primarily, and we decide to shorten the credit period, this results in customers either switching from us, customer reducing their volume of purchases from us, and customer also can ultimately uh, create a bad name for us in the market. That has happened in a few cases. I know of a few small businesses that tried doing that, but that resulted in more in a loss of sales rather than a saving in the working capital cost. Finally, vendor payable or payable turnover, if we can try to lengthen that, while it's good for us that we don't have to pay a vendor very sooner, but again, a negative impact like we saw in the stock turnover, that we may be receiving inferior quality goods, we may be giving up any discount that we may be getting, that means higher price, and again, this could result in our bad credit reputation in the market, where creditors then say that we will not be selling our merchandise on credit to so and so business. So it is very essential that the cost of all changes must be assessed. And finally, going beyond the numbers, there's not a lot of non-financial information that needs to be considered. We've discussed a few sparingly, but I'll be focusing more on this section in this coming slides. So the first thing that we need to consider is pestle analysis. Well, there are a number of models that we can use, but this is very simple model to follow. There are Michael Porter's diamond, Michael Porter forces, five forces, and we have pestle, we have SWOT, we have very many BCG matrix. Very, this is the, I believe, the most simple and the most comprehensive, in my opinion, the most comprehensive non-financial information barometer. So, pestle analysis is political, economical, social, technological, environmental, and legal. It used to be just pest before, just refreshing those who have given P3 or are giving what I believe it's strategic management now. So, political, economical, social, technological, environmental, and legal. So all of these factors can influence our business operations. Like we discussed when we were discussing sales, we had a legal threshold, a legal factor that is non-financial that impacted the finances of the company. The legal factor was change in taxation laws, and that again has again impacted adversely, where the customers are now put off that a lot of customers have been were about to get the delivery, they had paid up, but as per law, the company was required to charge additional FED to the clients before delivering the vehicle to them. A political, uh, it is very, uh, it is also a very important factor because each government that comes in has a certain political agenda or a sector of the economy that they wish to focus. Now, if we visit just the past two governments, so the both of these government had a one-point agenda that they made their flagship achievement of their uh, period governance period. So, if you look at the previous to previous government, they had introduced decentralization of the governance approach, whereby provinces were more free to take their own decisions, and they had a share in the national kitty as well. The previous government had a initiated a program against power shortage, power generation. So the power sector was their main focus, and they primarily focused on solving the power crisis in Pakistan and as a result, so companies operating in those specific sectors were very uh, were very optimistic and enjoyed a relatively good period as compared to other sectors. So if you just look at revisit the numbers, so we're not getting into political discussion. I'm just talking about the numbers here. So since the political uh, government of the previous in the previous tenure focused on the power sector, the textile sector and the automotive sectors were ignored primarily. So correspondingly, now in this government is focusing more on foreign investment and manufacturing sectors. So there is hope that because the companies will then manufacturing sector would might uplift. But then again, these are political factors that need to be considered. Economic factors that we have discussed. For example, in case of external sourcing, imported raw material sourcing, we need to consider that the foreign exchange rate is fluctuating, or currently Pakistan is in the economic position of Pakistan is towards a declining phase. So that means the fiscal policy is a contractionary one. So interest rates are increasing and the demand is decreasing. So this should impact negatively the sales of companies which are whose goods are considered uh, not necessities but luxuries. Again, social. For example, there are a lot of social factors that can be considered when analyzing non-financial information. Most critical social factor in Pakistan, I feel, is the community system that is built in our communities. So, if a particular community comes in power, that again connects with the political as well. So, that is something that companies need to look at. Technological, again, technology has over the past decade really changed the landscape of businesses, and tech-based innovations have disrupted uh, conventional businesses. The success stories of Uber, Careem, and Airbnb are in front of us. So these are something. The impact of this disruption is something that needs to be considered on the company's financial performance as well. So, for example, this is the sales of the advent of Careem and Uber in Pakistan meant that the sales of used Japanese reconditioned cars skyrocketed over the past couple of years. However, but now we've again taken the economic factors. The forex rate rupee has depreciated, so this demand has also plummeted. Further things we need to consider are environmental. Again, environmental legislations, like we discussed, for example, if it was outlawed that only electric cars or hybrid cars are allowed, how would that impact the finances of the company? How any environmental concerns among people are impacting the company. For example, a very good example is in Kenya, where they've banned the sale of polythene bags. So plastic bags are not sold in Kenya. So that has completely uh, disrupted and shut down one industry that was very successful and considered a very essential part to the economy. Legal, again, we've discussed the taxation matter, and moving on, we have management profile. So, management profile is who is leading the company and how competent the team in the company is. So we can have good equipment, we can have excellent raw material, but if you don't have competent human resource, so it all adds up to nothing. Because again, just revisiting basic economics, we have four factors of production: land, labor, capital, and enterprise. So we've got land, we've got capital, and we've got labor, but we don't have enterprise. We cannot make a proper business. Research and development: how much of the how much of the time and resources is the company dedicating to research and development. Again, the R&D culture in Pakistan is very slow compared to other markets, but we are picking up here once because the startup culture is starting to take off here, and research and development is critical. That because it's research and development always gives the companies an opportunity to further itself and not bank on its own cash cows. So this is something that we need to look at. Then we have the sustainability of the business model. So we have some business models that are very short-lived, and that we need to consider the complete working capital cycle and operational model of the business and impact of the one-off events on finances. This could be anything from a merger or acquisition or any change in management personnel and how that impacts the financial results of the company. For example, if there's a complete change in the management of the company and say a structural overhaul and restructuring, so new management coming in might take some time to find its to find its feet, and this will result in probably a slight dip in the financial performance of the company. Other matters that we need to consider is benchmarking that I briefly discussed initially. Now I'm just revisiting that. And for that, the most common competitor that we choose for Toyota is Honda. Now, well, the it is very they apparently look very similar, but if we say benchmark against similar size competitor, so if you take Honda, Honda may not be the correct fit, but because due to lack of options, it will be the only thing available. So I've just looked at a few factors. Not many there. While there are many factors to consider, I'm just considering them briefly here. The plant locations of Toyota and Honda, the portfolio of vehicles, and the product portfolio. And again, we delve further a little in their product portfolio. So in the case of Toyota, I had discussed briefly in the cost of sales section that the plant of Toyota is located in Karachi and Honda is located in Lahore, and this then gives way to uh, from a cost of sales perspective. So why? Because Karachi is the port city, so it, bringing in goods and directly to the port and at the side of Toyota would be cheaper than bringing the goods halfway up to Lahore. But on the flip side, if you look at sales, now now just remember that the manufacturing sites are from where the finished goods are dispatched. So if we look at on the flip side that Honda is at a more centralized location and Toyota's location is right at the south of the country. Well, Karachi may be the main hub, but the rest of Pakistan's urban areas are also developing and the demand for their cars is also increasing. And that is, I think, one of the factors where Honda has the advantage that they can have much better access to the rest of the country as compared to Toyota. Second factor is that we have considered is the product portfolio. Has tried to diversify its product portfolio. It has cars, SUVs, and pickups, whereas Honda's main focus is primarily on cars. They focus on Honda has three main cars that are currently widely available in the market: City, Civic, and Accord, which are 1300cc, 1800cc, and I believe 2400cc. So they have mid-level, luxury level, and high luxury level. Whereas Toyota has tried to diversify, it has SUVs in form of the Fortuner pickups, Hilux cars. We have Corolla, with variants in 1300cc and 1600ccs. So, and they also have huge vehicles like Prado, and they've also introduced a minivan, Vanza. So they're trying to diversify the product portfolio. Now, from a sales perspective, if we compare the two, then the comparison would be very unjust in the sense that their product portfolios are completely different. And again, uh, their plant locations have different implications for their cost of sales. Their plant locations will have different impacts for their distribution and marketing costs, because Honda, being located in central Pakistan, can ship off more cheaper to the rest of the urban areas of Pakistan as compared to Toyota. So, and there's differences again. If you're benchmarking against a local competitor, it is also uh, nice to. It is also good to know how the company tries to position itself. Honda has primarily positioned itself more of a as a sedan brand, and a sedan brand that promotes luxury as well. Whereas Toyota has tried to promote itself, trying to detach itself from its Corolla label and introduce more variants into its portfolio. Next, we have horizontal analysis and vertical analysis. We have the statement of financial position here. So horizontal analysis is very good for looking at trends, and so we're very good at looking for trends. And apart from that, so we have information over a period of time that we can compare. So we have property, we just identified property, plant, and equipment here, which I've highlighted, and we can see that there's an increase of 15.5% from the prior year. And again, we will need to delve down further into the details, that why are the numbers different, by drilling down. Other thing that we have visited was the concentration, be it in sales or be it in receivables, and that we can also do in the financial statements as a whole. So that will tell us how the funds of the company are being utilized. As you can see, our composition of assets here in 2018, it comes up to from 81 billion, we have 55 billion, that is a 67% in short-term investments, and then we have a further 11 billion in inventory. So that brings us like around 80% of our funds are stuck up in just two areas. And the last thing that matter that we need to consider will be the SIPOC process. It is a very good method to isolate and segregate business data. So if you look at the business cycle, it also represents that we have suppliers who give us the inputs. The inputs are utilized in processes, and the processes are then give the outputs, and the outputs are then used to generate customers. There we have things to consider like quality of suppliers, reliability of suppliers, diversity of suppliers. Then we have sources of suppliers, local or international, and how that impacts the number of inputs that we take. Then again, our manufacturing process, quality of machinery that we have. Then we have the outputs, the products that we make, diversification of the products, how diverse our products are, how similar they are, and how delayed is the value addition of the production process. For example, if we just take the example of Indus Motors, so we have their main suppliers are Toyota Japan, and their inputs are the car components that they import. Their processes are the manufacturing and assembling of the car. and their output is because of their, for example, we just consider 6 variants of Corolla available. They can delay value addition to the last moment, which are where differences are minor, like maybe differences in dashboards, differences in having power accessories, differences in engine capacity, but overall shape of and major fittings of the car are the same. And some differences in aesthetics like color scheme and quality of interior. And those are used to generate customers which are fragmented in nature and not fragmented in nature and cannot dictate terms to the company. So just to briefly summarize what we've discussed today, we recapped ratios very quickly. Then in, what matters we should consider individual when reviewing and checking individual line items of financial statements. How drilling down can change interpretation of numbers, like we just saw in sales, if you recall, that the units number of units sold increases by 6%, but the revenue increased by 25%. How to take a holistic view of financials. I just showed you the horizontal and vertical analysis, snapshot of numbers, profit and key numbers, return on assets, and how and where to benchmark. So benchmarking, we discussed it can be either prior year numbers or a similar size company, or maybe if you want to improve, we can look at the market leader in there. So with that, I'd like to conclude my session for today, and I think we can open for Q&A.
Yes, there are many questions that members have asked. I think Carol, Carol, are you going to moderate the questions?
Yes, if you can just give me 1 second. Just had a question by, she said, many of the questions have been answered, but there was one question that needed an answer. It said that, where's this one? People asking for, no, because many of the questions have been answered. There was one question that was remaining, but I guess that one has also been answered. So I don't see new questions coming in. There is one, Aruj Kamar, but she's left. She mentioned this is a manufacturing automobile company. Is it easy to do so? Yes.
Every business has its different dynamics. So the question was, sorry, the manufacturing automotive company, is it
easy to do?
I think if she's referring to analyzing it, then no, because every business financials are different, their dynamics are different, as we've just discussed in very much detail, how the business models can affect the numbers. So, well, every business is difficult to analyze because you never have access to complete information.
All right, can I go and ask a question? I mean, yes, I think her question was about companies in the service sector, and I asked her that if she has a particular question about a service sector organization, she could put it up here. But there is another question by Shahzad Khan. He said, why the EPS is higher by 20% when everything is in declining mode?
Why the EPS is in because the earning per share, because profit has increased, right? So the EPS is calculated by net income divided by average number of shares. So the net income has increased, but the average number of shares are same. So that would mean the numerator has increased while the denominator is same. So it would mean that the result is increased.
Thank you. Quick answer. The next one is from Omar Tarar, and he's saying property, plant, and equipment surely is the biggest part of fixed assets. What should we analyze in it, and how should we analyze this figure in relation to our production capacity and other profit and loss items?
Well, it is, yes, very well said, Omar, that it is also the very most critical part of the balance for fixed assets, the property and plant and equipment. So we need to, there's a variety of factors that I discussed that we need to consider that include the quality of the machinery that we have, the company policy, do they have a proper renewal policy, or do they try to defer capital expenditure by spending more on repairs and maintenance? So the things that we need to consider can range from the company's capital expenditure policy to the quality of equipment that we're procuring, how well our supply chain or procurement management, a procurement team gets a good quality machinery in the budget that it is allocated. So we need to consider a lot of things in that.
One more question that is from Abdul Ghani Ansari, and he says, can you please tell me more about horizontal and vertical analysis? How can we use them?
So horizontal analysis is more of a trend analysis, so we can identify and see the trend. So if we recall, we discussed in the sales section that seasonal variations. So the seasonal variation only comes when we look at the trend, and we can also have an annual trend that, okay, and we can correlate it with that to that other factors that we discussed as well. So for example, if Pakistan is in an economic boom, so if we just go back around, say, 12 years, 10, 12 years back, so the financing sector was in boom. So everybody was getting cars on lease because interest rates were very low, and the country was pursuing an expansionary policy. So that resulted in increased financing, and resulted in increased sales for increased auto financing, resulted in increased sales for Honda and Toyota. Correspondingly, if you want to look at composition, that where my funds are concentrated, or where any number is concentrated, you look at vertical analysis. So vertical analysis can be used, like we discussed, to check composition. We can do that, say, in the product portfolio as well. So if we, for example, if we analyze the products of the Indus Motor Company, so a huge chunk would be going to Toyota Corolla, and we can say, all right, so the sales are concentrated to this product. Or we can do a geographical concentration as well. So we would see probably that the urban centers of Pakistan have a higher sales concentration as compared to other areas.
Right. There was another question, but I guess this this current answer has answered to Wakarul Hassan's question as well. I hopefully understand that has. There is one more question that seems to be the last one regarding the narrow down approach. How many layers of reasoning should we touch for a particular point?
Well, depends how easily a manager is satisfied. No, but again, it depends on how easily that you can narrow down on the factor that is influencing the results. So if we have, if you're reviewing, say, cost of purchases, cost of sales, and the major chunk is, you narrow down further that, all right, raw material purchases is my major chunk. And then you further narrow down on your raw material purchases that, all right, I'm importing. So that's already 3 areas that I've discussed. So, and you say that, all right, let's revisit the trend of raw material prices, and let's revisit the trend of Forex prices. So that's level 4. So you can go from 2 levels to 5 levels to 10 levels, depending on how soon you zero in on the factor.
Right.
There are a couple of, Carol, there are a couple of questions that you've missed. There is one by Uruj where she's saying, for which ratio is the intangible asset most important?
For which ratio is the intangible asset most important?
Considered important, yes.
It
The
depends
ratio
again
that
on
goes
the.
around intangible assets.
It again depends upon the business model as well, because as for Indus Motor Company is just a number that adds up into the total assets. So here we could say that it's important for the return on total assets. But if you look at, say, a service sector company whose major investment is on IT, software, brands, for them it could be the return on investment or turnover as compared to intangible assets. So again, depends upon the business model and service business sector as well.
Okay, there are a couple more questions only, so we'll very quickly try to wrap them up. Muhammad Daud Ashrid is asking how to check the impairment of goodwill at the end of the year. Goodwill
That is
impairment.
the goodwill impairment is a very subjective area. Goodwill impairment, revaluations, because whatever estimations are involved, so there are a number of models that analysts use to calculate their projections. They can be very complex, or they can be as simple as, say, obtaining valuations from a couple of guys to, say, a very comprehensive, detailed model that can be used to project the earnings of a business and then the erosion, and then they compare it with the initial projections to calculate erosion and goodwill.
And the next question is from Wasim Khan. He's saying sales are mentioned and sales tax is deducted, but in fact, sales tax is not a part of the sales revenue. At the time of recording the invoice, sales tax is recorded as a liability. Any details?
Well, sales tax, because we're charging that from the consumer and we have to show that in our books as per disclosure requirement. So that is why displayed as gross revenue. But if you look at the P&L, I'll just open it back here. If there's so the P&L shows that sales as net sales. I'll just see, it shows that sales as net sales. So the readers of the financial information do not get misled. So our net sales are 140, but the gross sales were pretty much higher. Gross sales are 131. Sorry, this is a net number, but the gross sales were much higher. So these are actually disclosure requirements that companies must abide by.
Wasim is saying that his point is different. Wasim, can type your question again, and we'll come back to your question. There are a couple more questions. There's one which is slightly more personal, and Abdul Ghani Ansari is asking you how your MBA marketing helped you with your current role, and do you suggest ACCA members to go for MBA in marketing? Just your thoughts, very quick thoughts on this.
Well, actually, yes, because currently I'm as ACCA, while ACCA has given a lot of technical expertise and the thought process that I've been able to develop after going through the ACCA curriculum. But as technical experts, we are very good. But when it comes to selling ourselves or even marketing ourselves or marketing our product, that is something that I believe that certification programs miss, because they're focused more on drilling in the expertise of the areas of that qualification. So yes, it's helped me a lot professionally. Plus, the brand name always helps. ACC and IBA, it's a very good sell.
All right, Wasim Khan has come back. Is saying, in my opinion, sales tax is a liability and net sales should be gross sales minus commission and discount. Am I right?
Yes, Wasim, from a analyst perspective, you're perfectly right. But these are disclosure requirements as per the Companies Act. So these are some things that the company has to abide by. Because just 'cause if you step into the shoes of the regulator for a minute, so if I misdeclare my sales and I don't declare how much sales tax I've paid, so how can they cross verify it with the returns that the companies have filed? So and from an analyst perspective, you're very spot on. But from a reporting perspective, disclosure requirement is something that the companies have to abide by. Even if they don't want to, their auditors make them.
Okay, I think there are two more questions that have come in. Amir Amiruddin, I'm going to ignore your question. Sorry about that. But there's a question from Hafiz Muhammad Yasser. He's saying, when we analyze sales, what is meant by customer base, narrow/wide? Did you get the
This,
question?
yes. This refers to how concentrated our sales are. For example, if we look at, say, PSO, Pakistan State Oil Company, they would have a very narrow customer base because majority of their product is sold to the government of Pakistan either directly or indirectly for power generation. For Toyota Indus Motors, the customer base is very wide. So that all comes back to if someone recalls the Michael Porter's model. So the bargaining power of customers. So if the customer base is narrow, that means a few selected customers can dictate terms to the seller. But if the customer base is wide, as is in the case of Toyota, so the seller is not in a position to be the customer is not in a position to dictate terms to the seller.
Okay, the next question is from Safi Rashid Sayed. He says, does receivable qualify under financial assets? And under new IFRS 9, how provisions will be accounted for and impact financial analysis?
I haven't actually studied that area. I haven't been following that very closely, so I don't have an answer to that.
Okay,
My
IFRS
apologies.
9 is going to be our focus within the next few webinars. We're about to announce them, and
Excellent.
you get to hear a lot about IFRS 9 in the coming few days. Hafiz Muhammad Yasser is saying, kindly explain the terms capitalization policy and covenant requirements. And that would be our last question.
Okay, so capitalization policy refers to what criteria company sets for is a cost that is incurred that it feels should be classified under the category of fixed asset or intangible assets. Whereas covenant refers to any threshold requirement set by the bank or a lender to that the borrower must meet at all times in order to fulfill its the borrowing obligation. So if the covenant requirement is not met, then the finance facility may be withdrawn or the borrower may be penalized or depending upon the agreement.
Okay, thank you very much. I think there's a final question, but I don't think we can answer it now because number one, the time is over. Number two, the question is very broad-based. Ali Farouk was asking, explain the ratios for banking industry. So I think that requires a separate webinar in itself, not just so not just a small topic. However, I think good useful session, good refresher for members. I think interesting analysis of the automotive sector. I quite enjoyed it. I'm sure all other members did. Do share your feedback, your comments with us. And thank you so very much, Murtaza, for taking time out. I think you've done it very nicely. I think good analysis. So thank you all. Thank you for participating. My final announcement. and that is that you will receive the certificates for participation in a couple of days' time for attending this webinar. Secondly, the presentation that has been made as a PDF is available to you for download. And sorry, Murtaza, without your permission, I will ask them to download your presentation. We want to take them along. So it is available as handouts. If you go to your GoToWebinar menu, there is a section which says handouts. You can download this presentation from there. Number 3, the recording of this webinar will also be made available to all of you. So those who want to repeat certain concepts, go over it again, refer it to somebody else, by all means, you may do that. Final concluding comments from Amir Iqbal, Hafiz Muhammad Yasir, saying very informative session. Thank you for conducting this. Thank you, Amir. Hafiz Muhammad Yasir said, thanks for the responsive questions. So thank you, Yasir. I think the session got interactive in the end. I think that was good. Those who are unable to download the document, we will be able to share it with you afterwards as well. So Usman, don't need to worry. Mehvish Mehman says amazing session. So thank you very much, Mehvish. I think that's all. That's all we had to do. Thank you very much for your participation. And maybe some other time we will ask you, how was your experience of talking to the camera, Murtaza? This was your first session with the camera. I hope you enjoyed this session.
Yeah, I'm going to tell you that offline.
All right. Okay. Thank you very much. And that's all from the webinar from ACCA. Thank you very much and see you later. Bye-bye.
Thank you.